Good day, everyone. I am JCabanas. I am tasked to discuss financial planning and forecasting. Before I start, allow me to show a video clip on the consequences if we do poor financial management. Please take a look. So, we all need to be financially secured. So, this topic regarding financial planning and forecasting is indeed a good help to all of us. In order to grow and prosper, firms have to conduct two types of planning exercises. These are strategic planning and a subset of strategic planning, which is operational planning. And financial planning is a critical component of the operational planning process. In financial planning, the strategic planning is a long range in nature and deals with the overall direction of the firm. It is largely concerned with anticipating significant new developments and changes that will have a major impact in the industry and its firm. For example, few would have anticipated the years ago that e-commerce would become as big as it has. Companies did not anticipate this major development in how people buy and transact business are trying to play catch up to small but agile startups that have responded to this new way of merchandising. For example, the Barnes and Noble, the largest bookstore chain in the world. A few years ago, when the internet was still in its nascent stages, Barnes and Nobles did not think trading this medium was going to be a significant factor. For one thing, they felt the experience of going to a bookstore and browsing through the aisles could not be duplicated. As Barnes and Noble found out that this idea wouldn't be further from the truth, among all e-commerce ventures, buying books via the internet is one of the most dominant businesses, which is the Amazon, a firm that began operations and only in July 1995 caught the internet wave and now commands a majority share of all books purchased all over the internet. Barnes and Noble did ultimately start selling its books through the internet but remains a distant second to Amazon only. With a proper strategic planning process, Barnes & Noble probably could have positioned itself to better take advantage of the opportunities presented by the internet medium. So, for the operational planning, it lays out the financial resources that are needed to achieve the operational, including the financial objectives of the firm. There are two levels of operational planning, which is one, the long-term plans, other one is the short-term plan. The long-term plans are typically done over a 5-year planning horizon, while the shorter plans are conducted over a 12 to 18-month window. So the operational plan begins with a series of operational objectives. Some of the examples are raise market share from 12.5% to 17% in 12 months, reduce debt to total capital ratio from 65% to 40% in 2 years, reduce debt to total capital ratio from 65% to 40% in 2 years, or raising operation profit margin from 8% to 9.5% in a year, and reduce the development phase of a new product introduction from an average of 28 months to 12 months, and lastly, decrease in dependence on sales to the defense industry from 60% to under 40% in 2 years. So these are some of the examples of the operational objectives. So in order to address these objectives, the operational planning is crucial to a firm's survival in the short and long run. The lack of adequate operational planning has doomed many a firm, both small and large. For figure 4.1, an overview of the corporate planning process presents an overview of the corporate planning process to describe here. The strategic plan is determined by the long-term goals of the firm, but it also affects the operational objectives of the firm. The operational objectives, in turn, are implemented via operational plan, which consists of marketing plan, production plan, human resource plan, and financial plans. The dashed line from the operational plan to operational objectives and back to the operational plan indicates that the operational plan should be continually monitored to see if the objectives are being met or not. If the objectives are not met, then the operational plans need to be adjusted so that it is in the alignment with the objectives. Thus, the operational plan is not only for planning device, but it is also a monitoring device. An integral part of the operational plan and the financial plan are the financial forecasts. However, before discussing various financial forecasting techniques, the next section focuses on the cash flow analysis, which is an important element of financial planning. The firm must develop an operational plan, which consists of marketing plan, a production plan, a human resource plan, and a financial plan. Marketing plan lays out the marketing resources needed to meet the operational objectives and includes such things as advertising strategy, marketing promotions, channels of distribution, and distribution incentive, and assignment of sales territory. Next is production plan. This consists of facilities needed to achieve the operational objectives, including the number of shifts, plant refurbishment and expansions, vendor and supplier arrangement, and inventory control. Another is human resource plan. Let's now proceed to cash flow analysis. Traditional financial ratio analysis can be a useful tool to an analyst trying to evaluate firm's performance. However, many of the key performance measures such as return on sales, assets, and equity rely on accounting income concepts. Accounting income is not the relevant source of value in a firm. Cash flow is. Only cash can be spent. Accounting income, in contrast, does not reflect the actual cash inflows and outflows in a firm. Another topic would be the cash flow concept. The income statement can be modified to provide a quick measure of tax or after-tax cash flow, or ATCF, that is available from current operations to make capital expenditures, pay dividends, and repay debt. Accordingly, the ATCF is generally a more important number than the net income or earnings after taxes, or EAT. One shortcoming of the ATCF is that it does not consider additional cash tied up or released from net working capital. ATCF is found by adding back non-cash charges to AAT. So, it will be described as ATCF is equal to AAT plus non-cash charges. Non-cash charges consist of items as depreciation and deferred taxes. Hence, ATCF is equal to AAT and depreciation and deferred taxes. Depreciation is defined as a systematic allocation of the cost of an asset over more than 1 year. The annual depreciation expense recorded for a particular asset is an allocation of its original cost and does not represent a cash outlay. For deferred taxes, it is the difference between the tax amount reported to stockholders and the cash amount actually paid. Let's take a look at this example. During the 2002, PepsiCo reported the following earnings amounts to its stockholders. Earnings before taxes is equivalent to $4,868,000,000 less income taxes of $1,555,000. Earnings after taxes is $3,313,000. In income taxes for the current portion, it's $1,267,000, and the deferred taxes is $288,000,000. In calculating PepsiCo's 2002 after-tax cash flow, the deferred tax amount of $288,000,000 is added to the earning after tax because the deferred taxes were subtracted as an expense in determining earnings but did not constitute a cash payment by PepsiCo in 2002. Deferred taxes generally occur because of temporary differences in the stated amounts of assets and liabilities for financial reporting purposes and for tax purposes. Specifically, even though deferred taxes can occur for a variety of reasons, some of the more common reasons include differences between financial reporting and tax methods regarding accounting for depreciation, inventories, and pensions. The effect of depreciation and deferred income taxes on the after-tax cash flows of the Elwood Appliance Company is illustrated in Table 4.1. Using straight-line depreciation for financial reporting purposes results in reported income taxes of $8 million and AAT of $12 million. Using accelerated depreciation of MACRS for tax purposes results in a current income payment of $7.2 million with the balance of $0.8 million, wherein $8 million minus $7.2 million being deferred. If the tax records for Elwood are available, the ATCF of $22.8 million can be calculated by adding the depreciation amount of $12 million to the earnings after taxes of $10.8 million. If the tax records are not available, the ATCF can be calculated using figure 4.2. The ATCF is equivalent to $12 million plus $10 million plus $0.8 million equal to $22.8 million. Let's proceed with the statement of cash flows. The statement of cash flows together with the balance sheet and the income statement constitute a major portion of company's financial statements. Statement of cash flows shows the effects of company's operating, investing, and financing activities on its cash balance. The principal purpose of the statement of cash flows is to provide relevant information about company's cash receipts and cash payments during a particular accounting period. A statement of cash flows provides a more complete indication of the sources and the uses of a firm's cash sources over time. Let's go to the statement of cash flows using direct method. Table 4.2 shows an example of a statement of cash flows using the direct method for the Summit Furniture Company, a retail chain of furniture stores. During 2005, Summit's cash flows for operating activities totaled $14,600,000, where $142 million cash received from customers plus $600 or $1 million of interest received, less $120 million paid to suppliers and employees, less the $2 million interest paid, less the $6 million of income taxes paid. Summit's investing activities used net cash of $18 million. The company spent $19 million on capital expenditures and received $1 million in proceeds. During the year, the net cash provided by the financing activities equaled $3,600,000. The $3,600,000 is calculated as the difference between financing activities that require cash outflow and those that result in inflows. Summit had financing cash outflows totaling $3,100,000, where $2,600,000 as repayment for long-term debt, and the $500 million of dividends paid out. Financing cash inflows totaled $6 million or $6,700,000, where bank borrowed of $1 million plus proceeds from the issuance of long-term debt of $4 million, plus the proceeds from the issuance of common stock of $1.7 million. The overall charge is in cash as calculated with this. Net cash increase or decrease, net cash provided by operating activities plus net cash provided used by investing activities, net cash provided or used by financing activities. Thus, net cash increase or decrease is equals to $14.6 million minus $8 million or $18 million plus $3.6 million is equal to $200 million. Let's now proceed with the statement of cash flows using indirect method. The indirect method involves adjusting net income to reconcile it to net cash flow from operating activities. While most companies use the indirect or reconciliation method to report the net cash flow from the operating expenses. Let's take a look at Table 4.3, showing the statement of cash flow using the indirect method of PepsiCo Incorporated. In 2002, PepsiCo had net income or EAT of $3.3 million. Converting this net income to cash flow requires adding back non-cash expenses, including depreciation and deferred taxes. Then the PepsiCo adjusted net income from the accrual method required by GAAP to the cash amount by showing increases and decreases in its various current asset and liability. After this adjustment, PepsiCo had net income or net cash from operations of $4.6 million. In 2002, PepsiCo used $527 million in investing activities, primarily for capital expenditures and acquisitions. Financing activities used $3.1 million, and then the net effect of PepsiCo's 2002 activities was an increase in cash and cash equivalents of $955 million. The PepsiCo statement of cash flows gives a good feel for the effect that PepsiCo operating, investing, and financing activities had on its own cash position. Now let's go to financial forecasting. Financial forecasting consists of various techniques that can be used to determine the amount of additional financing a firm will require in the future. If internal resources of funds or cash are not sufficient to achieve its goals, then the firm must seek to obtain external funding from the capital markets. This section presents the overview of the financial forecasting process with emphasis on the important role of pro forma financial statements. So what's pro forma financial statements? It shows the results of some assumed event rather than the actual event, are usually an integral part of financing forecast. For example, an operating budget that shows the level of net income that can be expected if sales and expenses are at given assumed level next year is a pro forma income statement. Short-term forecasts, those that deal with 1 year or less, tend to be rather detailed, whereas long-term forecasts are more general. This section discusses the percentage of sales forecasting method, cash budget, the pro forma statement of cash flows, computerized financial forecasting and planning models, and using financial ratios to forecast future financial performance. Now let's proceed with the percentage of sales forecasting method. This permits a company to forecast the amount of financing it will need for a given increase in sales. This method is simple and can provide information using the pro forma financial statements and in estimating future fund needs. So, there are two methods that assumes the percentage of sales forecasting method. 1. These present asset levels are at optimal with respect to present sales, and most items on the balance sheet increase in proportion to sales increases. Now let's take a look at table 4.4, which is the Industrial Supply Company or ISC's balance sheet and income statement, wherein management forecasts that sales will increase by 25% or $3,750,000 next to $18,750,000, and that expenses including interest and taxes will increase to $17.7 million. One of the management's primary concern is the amount of funds or cash needed to finance the sales growth. Until now, the company has financed its growth by using both internally and externally generated funds. The company has reinvested most of its to determine the amount of additional financing necessary to reach the expected $18,750,000, the annual cash level of IEC management has made the following observations about the company's various assets and liabilities. 1. The cash. Management feels the company's cash balances are generally adequate for the present sales level and would have to increase proportionately as sales increase. Next, accounts receivable. The company's present average collection period is approximately 49 days. Third is the inventory. It should have increased proportionately for sales to increase. And fixed assets are being used at nearly full capacity, where management feels that fixed assets will have to increase as sales grow. And last, accounts payable. As the company purchases more inventory, its account payable balance will increase proportionately as sales increase. And last but not the least, notes payable and long-term debt. These are not necessarily have to be direct relationship to the sales level. For example, a portion of the company's future cash flows may be used to pay off the present debt. In summary, as the company's sales increase, its asset will increase proportionately to support the new sales. In addition, the current liabilities that vary directly with sales, namely accounts payable, will also increase. It means the difference between the forecasted asset increase and the forecasted current liability increase is equal to the total financing the company will need. In addition, this relationship can be expressed in equation forms as follows. Total financing needed equal to forecasted asset increase minus forecasted current liability increase, or A over S times delta S minus CL over S times delta S. This means A is the company's present level of assets that vary proportionately with sales, S as the company's present sales, CL is the company's present level of current liabilities that vary proportionately with sales, and delta S as the forecasted sales increase. Specifically, the increased retained earnings generated during the time period when sales increased from S to S plus delta S can be expressed in equation form as follows. Increased retained earnings is equal to forecasted earnings after taxes minus dividend, or EAT minus D. The additional financing needed can be calculated by subtracting the increased retained earnings from the total financing needed, wherein additional financing needed is equal to total financing needed minus increased retained earnings, or this formula below. So for ISC's forecasted growth in sales, the additional financing needed as shown in the figure from the table 4.4, this resulted to $750 million. Even though the financing will be needed gradually as sales increase, the ISC management has to decide whether to 1. Borrow on a short-term basis, 2. Borrow on a long-term basis, 3. Sell additional common stock, or cut dividends. Let's take a look at table 4.4, which shows ISC's pro forma financial statement for 2007. Assuming that all of the additional financing needed is in the form of a short-term notes payable. Examination of the selected financial ratios shows that this financing plan will increase the next profit margin on sales from 5% to 5.33% and increase the return on a stockholder's equity from 16.7% in 2006 to 19% in 2007. However, It also reduces the firm's current ratio, measure of liquidity, from 2.60 to 2.24 times and increases its debt ratio, or in measure of leverage, from 40% to 44%. ISC management would have to weigh those factors in determining how to obtain the $750,000 of additional financing that is needed. Now let's proceed to cash budgeting. Even though the percentage of sales forecasting method is a useful tool that can provide insights regarding financing needs associated with projected sales increase, cash budget can estimate more precise both the amount of financing needed by the firm and the timing of those financing needs. Cash budgeting plays an important role in the firm's financial forecasting process. Effective cash budgeting can help management identify potential cash flow problems. Usually, cash flow problems are easier to solve when they are anticipated. And in addition, a detailed discussion of cash budgets will be discussed in this section that contains a brief overview of budgeting. So budgets are simply pro forma financial statements that detail a firm's financial forecasts. They are used to plan, coordinate, and control. Now let's proceed with cash budget. Cash budget is the projection of companies' cash receipts and disbursements over a period of time. Typically, cash budget is prepared on an annual basis and subdivided into months. However, more detailed and refined cash budgeting is done on a weekly or even daily basis for some companies that employ good ongoing cash management procedures. These are also useful in determining the amount of short-term funds the firm may need to borrow to cover any projected cash shortages. Short-term borrowed funds are almost always easier to obtain when the need for them is anticipated. In addition to planning for any cash shortages, the cash budget also indicates the periods when the firm may have cash surpluses. Now let's take a look with the steps in cash budget preparation. First, estimation of cash receipts, which results directly from the sales forecast. Another one is a schedule of disbursements or payments that firm must make with others. And the determination of desired cash balance at the beginning of each month. So let's take a look with Table 4.5, Cash Budget Worksheet of Midwestern Manufacturing Company. About 30% of company's credit sales are collected during the months in which the sale is made, and all of the remaining 70% are collected during the following month. Thus, the total accounts receivable the company can expect to collect during the January are equal to 70% of the forecasted December credit sales plus 30% of the forecasted January credit sales. So let's take a look at Table 4.6, List of Midwestern's projected cash balance for the beginnings of January, February, and March. Note that the projected cash balance at the beginning of each month is equal to the projected cash balance at the end of the previous month. In this example, $50,000 is assumed to be the most appropriate minimum cash balance for the first quarter of 2006. This table shows that Midwestern expect to need the short-term loan of $31,000 in February to maintain the minimum cash balance of $50,000. This also contributes to the expected need for the short-term loan of $70,000. After projecting the need for the short-term loan in February, The cash budget in Table 4.6 shows that the loan can probably be paid at the end of March because the available cash balance of $84,400 will still be above $50,000 after repayment of $31,000. The company has indicated the repayment on the cash budget by adding another side caption, which is loan repayment. Now let's proceed with pro forma statement of cash flows. The statement of cash flows can also be used to determine how much additional financing a company will need in some future period. In operating activities based on sales and cost projections for the coming year, management forecasts that net cash provided by operations will be $21 million as shown in Table 4.7. The pro forma statement of cash flow in Table 4.7 details how Summit expect to achieve the $5,500,000 of net cash provided by financing activities. The company must repay $3 million in long-term debt that comes during the 2006. Furthermore, the company has decided to maintain dividend payment at the current 2005, the amount of $500,000 level, and not to issue any common stock. Needed cash will be raised using a combination of short-term and long-term sources, namely by borrowing $2 million under a bank line of credit agreement and by issuing a $7 million in long-term debt. Let's proceed with another topic, which is computerized financial forecasting and planning models. Financial planning models are often classified according to whether they are deterministic or probabilistic and whether they attempt to optimize, that is, achieve the most desirable level of the value of some objective function such as net income or stock price. A deterministic model gives a single number of forecasts of a financial variable or variables without stating anything about its probability of occurrence. This is estimated future revenues and expenses into the computer and receive as output as estimate of various financial variables. The sensitivity analysis is the one that determines the effect on the output variables of changes in the input variables. And the probabilistic models are the ones that provide financial solutions or decision makers with more useful information than other models. And lastly, the optimization models, which determine the values of financial decision variables, some objective functions such as profit or costs. Now let's proceed to the topic using financial ratios to forecast future financial performance. So let's analyze or give the meaning of discriminant analysis. It is a statistical technique that helps the analyst classify observations or firms into two or more predetermined groups based on certain characteristics of observations. In the context of financial statement analysis, the characteristics typically are financial ratios. One early application of discriminant analysis in finance was a model developed by Edward Altman to predict bankruptcy of the firms. Altman identified 5 financial ratios that contributed significantly to the predictive accuracy of his model. The following are net working capital over total assets. Second is retained earnings over total assets, EBIT over total assets, market value of total equity or common and preferred over book value of the total debt, and sales over total assets. Mr. Edward Altman's basic model was developed from a sample of 66 manufacturing firms, half of which went bankrupt. On the basis of analysis, he established a guideline score which could be used to classify firms as either financially sound or headed toward bankruptcy. The lower score, the greater the probability of bankruptcy, and the higher the score, the lower the probability of bankruptcy. In other words, the lower the values of the five ratios just listed, in general, the greater the probability of bankruptcy. More recent refinements of Altman's bankruptcy forecasting model have made it applicable to retailing as well as manufacturing firms. The newer model is about 70% accurate as much as 5 years prior to bankruptcy. To wrap up the Chapter 4's financial planning and forecasting, for growth and survival, firms have to conduct two types of planning exercises. These are strategic planning and operational planning. Operational plan consists of marketing plan, production plan, human resource plan, and financial plan. The after-tax cash flows is equal to earnings after taxes plus non-cash charges. Depreciation and deferred taxes are examples of non-cash charges. Financial forecasting involves a projection and estimation of the firm's future cash needs. The percentage of sales method, cash budgeting, and the pro forma statement cash flows and computerized financial planning are used in financial forecasting. The percentage of sales method is used to estimate the amount of additional financing that will be needed to support the given future sales level. Cash budgets are projections of cash receipts and disbursements over some future time period. And financial planning method is computerized representation of some aspects of firm's financial planning process. Planning models are usually classified according to whether they are deterministic or probabilistic, and whether they seek to optimize the value of some objective function.